What is going on, traders? Welcome back to the Traveling Trader. It finally happened. The S&P 500 made record highs today. After tumbling more than 30% from its February records, we have now fully recovered and surpassed that February high. So in this video, I'm first going to do an analysis of the markets on the S&P 500, tell you what we should be expecting. Should we be going up from here? Are we going to see a bit of a correction? We'll be looking at some historical data and see how this bull rally matches to the previous ones coming out of a bear market. And then, of course, as always, I'll be going over my stocks and options plays and what we can do from here, what stocks to buy now, and what options plays we can potentially leverage. But if you get anything out of this video, go ahead and leave it a thumbs up. Leave it in the comment section below. I'm excited to hear your opinion. Do you think we're going to go up from here, or are we going to see a retracement? Without further ado, let's get right into it. All right, guys, here's the S&P 500. As you could see, we already hit all-time highs. This pink line that I drew here is from the February drop-off, and we are now above it. We closed at 33.89, which is a record close for the S&P 500. Now, this is officially a new bull rally coming up from the March lows, and we'll take a look at previous bull rallies and see how this one fares in comparison to that, and what usually happens after we reach this point. Now, if you look back at V-shaped recoveries, even when we don't have a crash, but say, a correction like we did at the end of 2018, you do notice that that frequently we do see these small retracements after the larger V-shaped recovery. You see these smaller V's or these smaller triangles as you see here. So I would not be surprised if we end up seeing a retracement here and maybe a small correction, I don't know, maybe down to the central pivot point around 32.20 or so. Don't quote me on that. This is just based off of a rough visualization of what I see here. But you typically see these small retracements after huge V-shaped recoveries. Here back in 2015, 2016, we saw more of a W-shaped recovery, but still, after we hit the swing high, after we came back up and hit the swing high, we do tend to see a smaller retracement thereafter, whether you want to count this one or whether you want to count the one thereafter. So it's not implausible that we do see some sort of retracement here. However, in the long term, once we've established a bull rally like we have now, once we've established a bull market, if you look at historically, these tend to last forever. Now, they vary in length of time and they vary in percentage gained after the bull market is established. The last one, for instance, when we came out of the 2008 financial crisis, so the bull rally that officially started in 2009, that was one of the longest bull rallies in history. You could see here that it's 11 years between March 2009 and the March 2020 crash. And that one, we saw the S&P 500 increase by 400%. The one coming out of the dot-com crash, that one lasted 7 years. We did 101%. The one before that, between 1990 and the dot-com boom, that lasted 12 years and we did 417%. So you can see that they're varied, but the main point is that they usually last years from this point forward. It doesn't mean that we can't see a 5 or 10% correction. It just means that the bull rally will continue onward for years and will likely carry a huge amount of success with it in terms of percentage gain. But in my view, we're going to continue upward from here for years to come. And I will go over how to position your portfolio accordingly, because we have to be malleable as traders and investors. We have to be malleable with the market. We can't just force trades. Now, obviously, if you're a real long-term investor, you could obviously buy an index fund and just hold until you're in a rocking chair. But if you want to be a little bit more active, I'm going to give you some ideas. All right, so what stocks to buy from here? Well, if you look at my last video where I said it is more likely that we will hit all-time highs, and we did today, I was saying that this this rally coming from a bear market is extremely weird. One, obviously the speed at which it happened, but that's not really it. It's the fact that if we isolate the S&P 500, if we isolate the sectors within the S&P 500, we see that a lot of the sectors, besides tech really, a lot of the sectors are still battered. Here is what the financial sector of the S&P 500 looks like. We are still, from the highs, we are still 21, 22% off. Here is what the energy sector of the S&P 500 looks like, right? We are still, what, 40, this one's even more battered, 40% from where we dropped off in January, February. If we take a look at the utilities, right? This one is usually one that we tend to see boom along with the rest of the market during a bull rally or a recovery rally from a bear market. And if we take a look at at utilities, this one is down 16% still from our February highs. So there are still quite a few sectors, even within the S&P 500, that haven't recovered yet. Now, let's take a look at the business cycle diagram here. So this is off, I mean, this is a pretty common diagram, but this specific one I got from corporatefinanceinstitute.com. I do like to cite my sources. So if you take a look at the business cycle here, you'll see that we have the expansion, the peak, recession, which is where we dropped off from February, depression, the trough, right? And then the recovery. Now, recovery takes on many different shapes. Obviously, now we are recovering from a pandemic. So in my view, we should be shifting our focus from pandemic stocks, right? Like the work from homes, the online purchasing stocks. We should be shifting from those to recovery stocks. What are recovery stocks? Well, I just went over three major sectors: utilities, energy, financials. We all know about the airlines. We all know about the restaurants. We see the demand for travel now ramping up. If you missed buying the crash on technology, then I'm sorry to say, but I think you have missed the boat for the short term. Obviously, in the long term, you could still buy technology stocks and hold for the very long term. But in the short term, like where you see Microsoft at a 40% discount or Amazon at a 40% discount, I don't think we'll see that again for years to come. And here's what the technology sector looks like for the S&P 500, surpassing its February highs, right? This is not surprising. We see Facebook, Apple, Amazon, Microsoft. These companies have all made all-time highs during the pandemic. And it's not hard to see why if you look at the actual sector itself. So unlike the other sectors that I discussed, this sector actually grew in the pandemic, and we are now up 12% from our all-time highs that we saw in February. So if you missed this crash right here, then I mean, you can't lament over it, you just missed it. But I'll talk about technology because technology does factor into one of my plays, so I'll talk about it in a second. So play number one. I mentioned this in my last video. You can stick to buying these index funds. These sectors right here, XLU, XLE, XLF, you can actually buy these. You can buy them as stocks. They're actually ETFs, but you can actually buy these and just wait for the recovery. As I said, these stocks have not recovered yet. So utilities, energy, financials, these sectors haven't recovered yet. The one that has the most upside is energy, only because it's still down 40%. But a lot of this does have to do with stagnating oil prices. Financials is the one that I think most analysts are bullish on because this includes companies like JPM, Bank of America, Wells Fargo, etc. All right, play number two, look for distressed retailers. So retailers that have good revenues, good balance sheets, a good amount of cash, but for some reason haven't garnered the sexy reputation as some of these other retailers during the pandemic like Target or Walmart. So Kohl's, this one recently tanked. This one tanked today 14 or 15% after lackluster earnings. And this stock usually trades between $40 and $50, you know, pandemic aside. Ross is another one that still has a lot of upside as well. Now, Ross does report earnings at the end of the month, actually in a couple days. So I would wait for earnings before buying because you could potentially get it at a discount. And by the way, if you want access to all of my plays, my stocks, options, crypto plays, link is in the description. I send out all my trades, including my portfolio, in our private trading group. Another retail stock that I think is at a heavy discount is Nordstrom, JWN. This one is near the pandemic lows. I think we can get this at a super bargain for the long term. And that's the caveat here. These are long term. Don't expect to buy these and then the day after the video, expect them to go up drastically. It's very hard to announce swing trades because of the timing that these videos are watched. Sometimes if they're watched 3 or 4 days later and somebody enters a swing trade based off of an idea, the rally might have already happened. So I tend to isolate most of my swing trade plays in the trading group, but these are definitely long-term ideas. So that is idea number 2, buying distressed retailers like Kohl's, like Nordstrom, like Ross. Idea number 3, buying technology on the dips. I always advocate buying on the dips. You can't believe how many messages I get every day saying, oh, is Tesla good to buy right now? Well, Tesla has been making all-time highs for 3 days in a row. So yes, I mean, the higher that you buy, the more likely you're going to see a retracement. Your best bet, your best opportunity, and I've done many Tesla videos up till now, your best opportunity is to buy on the major dips. And for technology, something that's been rallying heavy, the dips will usually happen around the 21 EMA. So if you had bought Tesla for, and I've been saying this for a while now, if you've been watching my videos, but if you buy Tesla at the 21 EMA, you would have bought here, you know, back in May, the 21 EMA Tesla was under 700 bucks. You would have bought here at the 21 EMA back in June, Tesla was under 1,000 bucks. You would have bought here at the 21 EMA just a week ago, Tesla was at 1,400 bucks, and now we are at $1,900. And this trend continues for things like, if you look at Apple, for instance, right? Let's look at Apple and see what it looks like on the 21 EMAs. You know, if you bought Apple here at the 21 EMA in April, it would have been $269. If you would have bought Apple just 2 or 3 weeks ago, it was $373, and now we are currently at around $462. So the 21 EMA, as I call it, continues to be the great equalizer. It doesn't mean that you should only stick to that. I'm just saying that you want to buy blue chip technology stocks on the major dips. That will give you the best average price long term. Now, play number 4 is a bit risky, so this shouldn't be the cornerstone of your portfolio. However, buying these pharmaceutical companies, especially ones that are in the running for a vaccine, buying them on the dip, or buying cheap calls, whoops, what the hell happened there? Or buying cheap call options when it crashes, when it dips, kind of like Novavax here, it dipped to the central pivot point. And by the way, if you want to learn how to trade options or want help with your technical analysis, I do one-on-one training every month. There's a handful of spots that go quick. So hit me up on the first of the month if you want to sign up. But if you look at Novavax, the central pivot point here where it says P, this is just a fancy way for you guys that don't know what it is real quick. That's just a fancy way of finding support and resistance. But the central pivot point is usually a very optimal spot for Novavax. So buying these pharmaceutical companies on the dip, because when a vaccine is announced, you know, one or more of these are going to take off. So you have Pfizer, Johnson & Johnson, Novavax, Vaxart. You want to recognize their trends. Like in this case on the rally, Novavax does end up retracing to the pivot point, the central pivot point. So you do want to pick those up. In my opinion, pick those up at those retracements, or you can even buy cheap call options and sell them later for profit. You have companies like Vaxart. If you take a look at Vaxart's chart, this is another vaccine company that's in the running. But this one looks like, you know, when it hits the 50-day moving average, then it's usually a good buy point. Again, you could buy cheap calls on the days that they tank to the 50-day moving average and make a killing once they run up. And play number 5 is just buying an index fund. You hear this all the time, especially if you're a passive investor. You could buy something like the SPY or something like SPHD, but this is just an index fund. Like the SPY tracks the S&P 500. So whatever the market is doing, you will be invested in the overall movements of the market. And this is definitely a buy and hold situation. SPHD is one that tracks the S&P 500 as well, but it's considered a low volatility ETF, so you don't make as much, but you also don't lose as much on the drops. It's very much for passive investing. Anyway, guys, I hope you like this video. If you do, give it a thumbs up. If you want access to the trade alerts where I send out my stocks, options, crypto plays, link is in the description below. Let me know in the comment section if you think we will continue to rally or see a correction from here. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.